So the key here is understanding the tax base, and taxes can be categorized according to their tax base, and a tax base is the thing that is being taxed. So let me give you a few examples to hopefully help you understand what I mean by this. So with income tax, what is the thing being taxed? Now, income tax is a tax on a person's income, what they earn at their place of work. So when you're taxing someone's income, what is it that's being taxed? Well, it's either the person's income in the case of an individual, or if we're talking about corporations, what we're taxing are their profits. When you look in the income statement, you have the revenue and you subtract a number of expenses until you get to profit before tax, and that is what is taxed. And the tax base in those cases is income or profits. Capital gains tax, that's a different kind of tax, and that is a tax on assets. A capital gains tax is a tax you pay on the increase in value of your assets. So for example, if you own a number of properties and they increase in value, then that increase is taxed via capital gains. So in that case, the tax base, or what we might say is the tax base of capital gains, is assets. Let me give you another example. VAT, value added tax, is a kind of sales tax in the United Kingdom. What is the tax base of VAT? This is a slightly different one. In this case, it's actually the consumption of the goods. It's the purchase of goods or services on which VAT is charged. So in that case, the tax base is consumption. So there's a few different examples of how we identify the tax base, so the thing that's being taxed that is underlying the actual tax. So you'll find that in most countries, income is separated into different types of category, and each category has its own specific set of tax rules that are applied in order to get the right amount of tax for the right kind of income. So generally, this splits taxes into two categories. The first one is direct taxes, and with direct taxes, it's a tax on the person who actually pays a tax. So to give you an example, we looked a second ago at income tax. Now the tax base of income tax we said was income, the individual's income that they earn. And so in that case, the tax is applied to that person's income, and it's a direct tax on that individual. The same applies to corporation tax. What's being taxed in that case? What's the tax base? Well, it's a company's profit. So that individual company is being taxed directly for the profits that they have earned. So that's direct taxes, which, as you can see from the examples, are usually charged on earnings, income, or profits. And then opposite to direct taxes are indirect taxes, and these are taxes that are on a section of the economy. So if we take, for example, sales tax or value added tax, when you think about those taxes, you may go into a shop and you purchase something and you pay VAT on that. But that tax, that VAT or sales tax, isn't directly on your income or on you. The tax is on the general consumption, the purchase you are making within the economy. And so we say with indirect taxes, they're not directly on individuals or on businesses. They're on a section of the economy. In this case, with sales tax, it would be consumption. So that's the key difference between direct and indirect taxes. And usually with indirect taxes, it's not the individual who actually hands over the tax to the tax authorities. If you think of when you go into a shop and you make a purchase and you pay VAT on that purchase, you don't actually have to do anything about giving your VAT to the government. That's the business's responsibility to do that. So that's another feature that makes it indirect. Another example of indirect taxes is what's called a cascading tax, and that is a tax that is charged at every stage of the supply chain. Okay, so to give you an example, when the factory buys goods from the raw material supplier, tax is paid at that stage. And then when the factory sells goods to the wholesaler, tax is paid by the wholesaler at that stage. And then when the wholesaler sells to the retailer, tax is paid at that stage. And for that reason, it's called a cascading tax. And it does lead to a bit of an issue with indirect taxes. And we end up with something called the cascading problem, because we are paying taxes at every stage in the supply chain that can have an impact on the end consumer. So let's take a look at what happens, why cascading taxes can be a problem, and how VAT overcomes that. So I'll give you an example to show you, firstly, what happens in a cascading tax. So let's say in this case, we have a fixed rate of tax, which is 10%, and that is paid at each stage of the supply chain. So every time there is a purchase of goods. So in the first case, we have our wholesaler and we have our retailer. So our retailer buys £5,000 worth of stock from the wholesaler, and because there is a 10% fixed tax rate on sales, they need to pay £500 in tax, £500 being 10% of the £5,000 of stock that they just purchased. So the cost of the stock plus the tax that the retailer has to pay makes the total cost to the retailer £5,500. Now, the retailer wants to make a profit on the goods that they sell, and they decide that they're going to have a markup essentially of £5,000. So they want to make £5,000 profit. So in order to make that profit, they need to sell their products to the consumer for £10,500. So they're adding an extra £5,000 onto their products in order to make a profit and be profitable. That means the consumer is going to have to pay £10,500 for the goods. And in addition to that, because again, we have to apply the tax rate, they're going to have to pay an additional tax of £1,050. So the total cost to the end consumer in the cascading system is £11,550. So can you see here that because we have tax applied at each stage in the process, the tax included here made the cost higher for the retailer, and in order to maintain their profits, they had to increase the cost to the consumer, which once tax was added meant the consumer was paying £11,550 for the goods that they ended up purchasing. Okay, and in this case, if we add up the tax that's collected by the government, we have the £500 tax that the retailer paid and the £1,050 tax that the consumer paid. So the government collects £1,550 in tax based on these various transactions. Okay, now some countries have attempted to overcome the cascading problem by introducing a kind of sales tax known as value added tax, or VAT. And the idea of that sort of tax is that tax is only charged on the value added at each stage, and so you'd have a wholesaler and a retailer able to make claims or to claim back tax that they've paid on purchases, because they only have to pay tax on the value that is added, not the whole amount of the purchase. And we'll see how that works in an example and how VAT overcomes this cascading problem. So let's see how the same scenario would play out with VAT. So we have a wholesaler and we have a retailer, and the retailer is still buying £5,000 of stock, and they're still going to have to pay £500 of tax on it. But under a VAT system, we use the VAT return. And in a VAT return, essentially what you have is the output tax, so the amount of tax paid on sales, less the input tax, the amount of tax paid on purchases, and whatever the difference is what the retailer will pay to the tax authorities. So in this case, the £500 of tax they pay on their purchases is the input tax, and that goes on this line here. And so when we continue on, the retailer has only paid £5,000 for their goods that they've purchased, because they can reclaim the £500 of tax, the input tax. And so in order to get that same margin, they want to make £5,000 profit. So they add £5,000 to this cost, which means they can sell the goods to the consumer for £10,000 rather than £10,500 as it was up here, which means the consumer also pays less tax. Rather than £10,050, they only pay £1,000 in tax. And that is what the output tax is. So the retailer will collect £1,000 tax from the consumer. They'll subtract the tax they paid on their purchases, which means the retailer only has to pay £500 in tax to the authorities. And that keeps the cost down for the consumer as well. So in this case, the consumer only pays £11,000 rather than £11,550. So quite a significant saving. And the government will collect slightly less tax, but in this system, there is less tax to be applied at each stage, and so you have a more efficient process. So what a VAT tax or an indirect tax does is that it reduces the tax burden on the retailer, because they can cancel their input tax with their output tax effectively. They have a lower tax burden, which is then passed on to the end consumer in savings, because they can charge a lower price whilst maintaining the same margins. Okay, so that's the cascading problem related to indirect taxes, and those are our two main categories of tax, our direct and indirect taxes. So if you found that video helpful, remember to like and subscribe on YouTube to make sure you're getting all the latest Astranti updates. And you can also find us on other social media platforms. We are on Twitter and on Instagram, and you can find us on Facebook in a number of different places. We have groups for operational strategic management case studies. So have a look on Facebook and see if you can find the right group for you.